Liz Ann Sonders, Charles Schwab, chief investment strategist, joins us now. It's good to see you. Welcome back.
Thanks very much. Nice to see you, too.
As Mr. Kaplan was just suggesting here, there is going to be some level of uncertainty at minimum related to the Fed in 25. What about the markets at large?
So, what's been happening since the election, in the early part of the post-election period, there was a lot of enthusiasm about how strong the market was. But of course, that represented a shift back up to the mega cap tech and tech-related names, Magnificent Seven kind of names. And throughout that process, we've actually seen now correction level declines and bear market level declines. If you look at the average member maximum drawdown, whether it's for the S&P minus 11%, for the NASDAQ minus 21%, since that election period of time. Now, at some point, that breeds opportunity, because that's similar to what happened in the first half of 2024, where you had all the performance up the cap spectrum. There was a lot more churn and weakness under the surface, but that represented the setup for some of the broadening out that we started to see in that mid-July to early August period of time. So I think it does represent a setup at some point. I'm not quite sure we're there yet, though.
I mean, the more there is this level of uncertainty, the more chance you have of the top cap stocks leading the show again, right? I mean, you need rates to come down, and you need some degree of certainty to underscore why the broadening of the market would be likely to happen.
Yeah, I think rates coming down is an essential ingredient for a continued broadening out. That was part of the trigger for that move starting in mid-July for equal weight outperforming cap weight, for Russell 2000 doing well, because there is more interest rate sensitivity as you go down the cap spectrum, a higher percentage of zombie companies, smaller companies that have more variable rate debt, and they are more at the mercy of what's going on in the interest rate backdrop, both on the short end and the long end. And given this move that we now think is cemented, at least in the near term, of the Fed having gone from easing policy to pause mode, I think that has been one of the contributing factors to this shift back up the cap spectrum to those stocks that don't, all else equal, get hurt by that stickier, higher interest rate backdrop. So, yeah, I think lower rates is certainly an important support if you want to start to see that small cap grind higher again, like we saw earlier in the year.
So you would stay away, just to be clear, from small caps?
Well, small caps is a pretty wide universe. I think it's if you're talking about the Russell 2000, almost 2,000 names, viewing it through a monolithic lens doesn't make a lot of sense. I think you can separate profitability versus non-profitability, zombie versus non-zombie. So when moving down the cap spectrum, stay up in quality. And there was a portion there of the small cap rally where you did see that lower quality trade kick in. You saw it in the non-profitable. You saw it in the zombies. And we were saying through that process, that's what you want to fade within that small cap rally and lean into higher quality. So I still think there are opportunities. In fact, if you look at the top 10 best performers in the NASDAQ year to date, none of them are in the Magnificent Seven. None of them are large cap names. They're all small to mid cap names. So there are opportunities there, but you want to maintain that focus up the quality spectrum from a factor standpoint.
What do you make of this notion that was put forth earlier by David Zervos of Jefferies, who began the 9 a.m. hour with us, who said there's just too much being made, too much emphasis being put on tariffs and immigration and all these other issues, that the policies that are going to be pro-growth, tax cuts and everything else are going to just supersede all of that. We could get a 15 to 20% return out of the S&P in 2025, possibly even hotter than that, he said. What do you think?
Well, that's possible. We have to remember there's a timing mismatch, because at least if we go by the word and not to mention executive order versus congressional approval, you're talking about tariff and immigration policy being front-end loaded at the beginning of the year, and assuming not much gets done on tax policy until you actually get to the point of expiration of the 2017 tax cuts. That is later in the year. Yes, you could bring that deregulation piece a little bit earlier in the year, but I think that's it's the timing mismatch that adds to the uncertainty associated with tariffs and immigration, because those can be done via executive order for the most part and don't need that congressional approval.